Hey guys. I'll be moderating it today actually. I think Sierra needs a bit of a break. Panel after panel is a rough thing to do. Before we begin, I'm actually going to get my esteemed panelists to introduce themselves one by one. The discussion I'm hoping to achieve today is something which is completely unrelated to the list of questions I have in front of me. And I hope that it will be something which, above all else, is insightful, but more importantly, practical as we move forward in this space. So, Alex, can you go ahead and introduce yourself, sir?
Yeah, thank you so much for the Bujidao team and for Taipei Blockchain Week for having me. Keep my intro as short as possible. I'm one of the original 4 partners at Republic Crypto, and I built out our token design playbook and oversee our research and economics teams, which is the cornerstone for a variety of other business lines that we have, spanning funds we do off a balance sheet, LP funds, as well as syndication. As well as regulated sales through crowdfunding, as well as broker-dealer facilitated token sales. And we also run infrastructure for a lot of our portfolio companies whose tokens my team has designed. And yeah, that's me.
Good seeing you here, man. Hi all, I'm Roy from Longhash Ventures, and thank you so much to Taipei Blockchain Week and Bujidao for inviting me here. I'm usually based in San Francisco, but it's so good to be back in Taipei, where I was born and raised. So, Longhash Ventures is a Web3-focused venture capital firm. We currently have 2 funds. Fund 1 was focused on DeFi, and some of our earliest investments were Balancer, Dodo, CowSwap, for example. Fund 2 is focused on infrastructure, so Safe, ZK Sync, Chainmail, Primeth are some big sample portfolio companies. We also have an accelerator arm, and we're currently running 4 cohorts, AI with Filecoin, ZK with ZK Sync, Cosmos with Atom Economic Zone, and gosh, I always blank on the last one. Oh yes, Smart Accounts with Safe. And it's great to be here.
Hi everyone, I'm Ciara, founder and managing partner of C-Square Ventures. We are a $100 million early stage venture capital firm in Web3. So what we're aiming to do is not just put down the money, but help our portfolio companies to grow. Prior to founding C-Square Ventures, I was head of listing and investment at FOB. That's how I got into the industry, 2017, and also managed global markets and institutional business unit for FOB, so got a lot of hands-on operations experiences with helping projects to scale, especially bridging them between East and West market. And prior to crypto, I have a traditional finance background, Boston Consulting Group at New York. Very happy to be here. I was actually a speaker back in I think 2018 or 19. That was my first Taipei Blockchain Week, so thrilled to be here.
Thank you very much, guys. And just by way of introduction, my name is CJ. I run the EMEA and APAC sales teams over at GSR. We're the largest market maker in the space when it comes to altcoins. And we work with, honestly on the board over there, we work with a bunch of guys on that board. Prior to joining crypto, I was actually in traditional finance. So I spent more than 10 years on the trading floor at Morgan Stanley and Nomura up in Hong Kong. So let's dive right into it. And what we're talking about today is really the landscape going forward for blockchains, not only from a business point of view, but investable point of view. The first question I have, and really take turns answering, I'm not going to start allocating it, but a number of companies in Web3, actually not even a number, I would say 99.9999% of companies in Web3 still operate on a negative cash flow basis. And how they remain viable is via VC funding round after round after round, which is nothing wrong. But we recently saw a very large behemoth, something very similar in terms of model go down in the form of WeWork. Is there anything different that you see in the Web3 space, a catalyst where we don't end up going down that path and something changes that makes it viable?
Yeah, I would say I want to address the situations where I think negative cash flow is a possibility to do in perpetuity, and the other one where it absolutely isn't. In regards to, I think the traditional, or what I would say, what is the status quo today, the most generous narrative about the tokens that we're generating now is that they're purely scarcity-based commodities, which have some utility in granting access to certain features, products, perks that we are consequently building. However, I do not think this is long-term sustainable, especially for VC-backed investments or VC-backed companies. And solving the cash flow problem I think, requires us to take 2 steps back in terms of what types of products we're building, what types of users we're trying to attract to them, aka, do we really want to only keep serving mercenary users farming airdrops and other forms of token earning, or do we want to figure out how we're going to build products that solve problems? Only on that basis, I would say, every layer one is going to have to figure out what to do after they can't continuously just fundraise off of a listed token, and how cash flows back into their own treasury is going to help sustain them once the VC money eventually dries out.
Roy?
Yeah, to follow that, definitely we need to find a path to sustainability once VC funding dries out. And I think for sure that's the direction we have to go on. But taking a step back, philosophically, crypto as an industry keeps on shooting itself in the foot, in that we can't decide if a protocol is a business or a public good. And if we are a public infrastructure, then we can think of protocol fees as tax. And as we have seen, users tend to vote with their feet. Americans are moving to Florida and Nevada for zero income tax, and Germans are moving to Croatia. And I think in the long term, as the layer 2 war kind of continue to pan out with different approaches to MEV, we might see some of that migration. But on a protocol level, we're seeing more healthy signs towards sustainability. The most notable example recently is Uniswap, turning on its front-end fee for 0.05%. But it's not at the protocol level yet. And we've also seen CalSwap actually floating a vote to turn on their fee structure and mechanism at a protocol level. And that kind of instigated a fierce debate around what a protocol really is at its essence, if it's a public good or if it's a business. And we've also seen the other side of the equation play out, where I saw one DCF being proposed on the Lido forum, and immediately faced a community backlash where they were saying, hey, we need to stop using these terms about cash flow, profitability, because protocol is for the community. So I think in the short term, we might see more protocols remain tax-free, for lack of a better term, and fees being turned on the front end. And eventually we'll get to the point where we realize that we need sustainability built into the very mechanism of the protocol itself.
So the reliance on VC money injection for operations of companies is definitely a problem, not just in Web 2, but in Web 3 as well. However, I think some of the differentiations here is that first, for crypto, it's about ecosystem and community. So a lot of the tokens accrue value not just based on whatever product they're launching, but it's also a full ecosystem play. And I think a good example would be Chainlink. The token used to not really work. It was a payment token, so the more you spend it, the more it crashed. However, with their recent updates of, I think it's the staking mechanism that they're using, that they are giving out rewards of hundreds of protocols that the labs is incubating and helping, which accrues values not just from Chainlink itself, but also the full ecosystem. I think that works better for Chainlink token, and we see the results obviously. And I think one more thing is the tokenomics design. So back in the first round of GameFi, when it really happened, it was Axie. The game didn't really work. However, the token pumped so much because it's only worked in the art market. So I think paying more attention to how you design a token, how to accrue value on the token or the equity side of the business is very important for the founders to think of in the near future, to make sure that they can figure out something that works for revenue generation and in the end, having a more healthy runway and maintaining a good, healthy operations of the business.
Fantastic. So I'm going to actually bounce on what Sierra just said. That concept of token economics, right, and that shift. Chainlink was a very good example. And my next question, I'm going to get Alex to start off with. What do you see in the realm of token economics changing? Is there a lever, is there a magic switch that we are going to see the next wave of projects come up with that offers that type of sustainability? Or, as you rightly mentioned, is it going to be the concept of farming airdrops, staking and receiving tokens for other projects, for instance? Is there something more that we're missing?
There's no single switch, but I will do a shameless plug and check out Republic Crypto Substack, where I've published multiple either long-form thesis pieces or more academic-level mechanisms, which I do think help solve some of these problems. But I think after doing research now for the last 5 years, one biggest thing I understand right now is that single mechanisms are not enough to sway a whole entire industry. You need to build basically a new playbook in order to get your portfolio companies to adopt them. That's been something that's been one of the biggest challenges I've worked on over the years. In this regard, right, the typical, there's so many assumptions of tokenomics that have become stigmatized, mythologized, and otherwise just practiced with utter incompetence, right? The first one being that if a company wants to build a type of pseudo-commodity backed treasury, which is to say that, oh, the first thing I want to do is I want to emit tokens to users and then ask for them to, very erroneously in my opinion, pay for our services back in that same token, which creates as I'm sure you guys can understand, a circular reference of value, which completely relies just on the market to price the goods of your, the price of your goods and services in that way. So for example, Ethereum and Avalanche gas calculations are not different. The main reason, though, that Ethereum gas prices are so expensive is because the token is expensive. So this does not mean that one of their models is better than the other. Rather, they both, in a way, still rely on this circular referential value. And then in terms of tokenomics, I think after all these years, I have 3 main things to give to any founder or investor due diligencing a token. That there are 3 main forms of value accrual. One is hard cash flow tethers. You either go cleanly into this with security tokens, or you figure out how to take token gated contribution, aka things like validators, ZK provers, things of this sort, and supplement their fees with what can be considered like a commercial value of their work, as opposed to just a cost-based value of their work. Number 2 is soft tethers to tokens, aka what is this token redeemable for, either by spending it or by, in my more greater favor, by locking it for some dedicated amount of time. What perks would companies otherwise, projects otherwise be able to offer in exchange for tokens being locked, instead of maybe the small amounts of revenue that could be made by charging for it, and also the additional friction. And then finally, when you have those pieces together, you have the utility for the treasury. If you were going to spend $500,000 in acquiring 10,000 MAUs through a marketing campaign, and you can accomplish the same outcomes by emitting 100,000 tokens before they are listed, then you are able to evaluate a potentially a much more capital efficient way of achieving these outcomes you would have otherwise spent $250,000, $500,000, or depending on how large of a company you are, millions of dollars, and pray to get those outcomes. So that's where I'll start on that topic.
Thank you, sir. And over to you, Ciara. I've got a question where it links back to that concept of ecosystems. Do you think, or do you foresee a world where we actually expand that ecosystem? Because right now what it seems to be is all of the layer 1s, layer 2s, dApps, and everything in this space is cannibalizing the same ecosystem. They're literally taking turns to sit on top of the totem. Do you see a world where we are able to bridge it, open it, and actually bring more into this ecosystem so that the pie itself does grow?
That's a great question. So for us, we think the future is all going to be multi-chain and cross-chain. So we're not really going to be competing for the same dApps and same TVL over over all the different kinds of landscape. It's all going to be interconnected. So that's like the future that we foresee for crypto itself. And I think in order to achieve that, we need good bridges to work, and we need aggregate liquidity. I think that's like the key thing that's missing in this market right now. So what's gonna be needed is that aggregate liquidity to really be able to facilitate institutions to come into the market and trade. Because right now that's, I think, what's missing for DEXs, right? Liquidity issue, and also just the full UI UX, it doesn't really work. And I think with the right framework and more clear instructions from the regulators across the different countries, it's definitely something that's going to help with growing the full ecosystem as well. We're seeing Asia is definitely growing so much stronger in the past year or so, with Hong Kong leading the way for regulations, and we think that whole ecosystem in Asia is growing so much more with with regulated retail exchange license, classifying NFT as commodities, and with the right help and pushing from the flows from the traditional market, that's going to be one of the main catalysts to grow the pie as a whole.
Fantastic. And over to you, Roy. You mentioned the concept of the tax concept behind Layer 1s, and I've heard this opinion before, which I think is getting more popular in the space. But there is another aspect where, do you think right now the table of Layer 1s and Layer 2s coming out, is it getting too crowded? And if so, what do you think will happen? Will there be new players? Will there be acquisitions and mergers? How would you see that space evolving?
We're already seeing acquisitions and mergers, and a lot of them are token-based. And it's usually interesting as the acquired entities kind of put the acquired entities head-to-head in competition on which ecosystem would ultimately be more accretive. But all of this still feels like a zero-sum game, and that's because every transaction today is still commoditized. Like one transaction that swaps an ETH for GLP is no different from another transaction. So until we can get more value-added services and products on-chain, aka adoption, that we're also excited to be in Asia for, because we're seeing a lot more friendliness, a lot more open-mindedness, a lot more avant-garde attitude towards transacting using crypto-native currencies. Until that happens and you can go on an app and order a pizza, and then you can start comparing, okay, maybe the pizza on Sui is a little bit better than the pizza on Aptos. Until then, every transaction is a commodity, and there is a kind of race to the bottom when they're evaluated just on the spectrum of lower taxes.
Fantastic. So we've done the whole sing around the campfire, singing Kumbaya, and pretty much the panelists are very similar in their viewpoints. I want to take it to a different direction right now. From an investable concept now, how would you compare investing in the space from 2021 to where we are at present and to where we go from here?
How much time?
I'll give you 3 minutes and I'm going to hand over for the next 3 minutes to the rest.
Alex, you're going to have the rest of the stage. I'll see you later.
I'll try to make mine super quick. Without going into further explanation, ICOs and the advent of like Layer 1s gave rise to like Professor Shitcoins in 2018 and later into 19. There were a few of these that stood out and prevailed today. And then after DeFi summer, a Polkadot run and things of this sort, we saw a lot of DeFi coming up, and we invented this metric called TVL, and then we started thinking about how we can maximize that as our main metric that we look at. Then there now, as of like last year, we've all been like, oh, what's mass adoption? What's mass adoption? For me, I can say what I look at, and referencing actually a panel that I was on with Sierra yesterday, and a really good point he made there is I should probably plug my portfolio companies more on the stage. There are three areas that I'm emphasizing right now. The first one is we're getting closer to the idea of application-specific infrastructure, meaning that it is going to be increasingly easy to turn a key and have a roll-up for yourself, or a network of validators for yourself, as long as you're willing to put in the work for that integration and for that specification. Yet the immediate problem that comes with that is scattered liquidity, scattered UI, just scattered value, right? And so I think bridging that liquidity, aggregating that liquidity, Sierra and I actually share a portfolio company called ZK Link, which I would shout out in Figure, trying to solve this problem obsessively, which is if everyone's going to have their own siloed roll-ups on Ethereum, how are we going to get all of the liquidity there accessible in a seamless way where people don't have to access bridge after bridge after bridge? The second thing I'm looking at is the idea of verticalizing the application layer and the infrastructure layer. So it comes naturally in association to the first point, which is that I don't want to see ecosystem token layers that have dozens of shitcoins on top of them. Per one of the thesis papers I put out in 22 called the super token thesis, I want to see them combine forces. Even if you're going to build the infrastructure and app layer separately, you have to sell together, because the end user is not going to pay or feed multiple monetization streams, open multiple apps just in order to accomplish what they want to do on a day-to-day basis. This being said, that we need to then figure out if we're going to accumulate value, where is it going to happen on the application side or collecting more notional concepts of tax at the infrastructure side, and then how is that going to actually be distributed without confusing the user across holding multiple tokens, maybe sometimes in multiple wallets. So that's one thing, and I think plenty of projects in the Avalanche subnet world, as well as in the Cosmos world, do try to accomplish this. I'll shout out Nibiru, as well as some of our clients working on the subnet side of things on the enterprise side. And then I would say my last one, oh my god, I'm blanking on it right now, my own investment thesis. Here it is. What's the catalyst for real monetization on the app side? In games, Apple took away something called IFA, which essentially allows, without going into any of the technical details, to not allow for games to place ads, or rather, for advertisers to place ads effectively because they could not access user data, and therefore those ads became less effective, so they made less money. The question is, in crypto, if we are going to get users, battle passes, microtransactions, these are not going to make a huge dent, in my opinion. Ad revenues can. The question is, can we replicate what Apple's and Apple platform distributed games had with something in the Web3 space? I would say these types of questions of what really makes a lot of money, let's focus on that, and then everything else we can allow for a token to access gate. This is, I would say, a set of mechanisms that give me a lot more confidence to show that a founder is thinking about long-term monetization, and that beyond any novel or otherwise gimmicky technology is important to me.
Fantastic. Roy?
Yeah, sure. I think in terms of macros, the next year is going to be a great year to raise compared to 2021, because a lot of teams who did raise in 2021 are experiencing severe down rounds. And currently, this is a good time to kind of straddle on a little bit more capital to fuel the next phase of growth as we see the next bull market pan out over the next 18 months. And in terms of our what we'd like to see in teams that come to us for potential partnerships, we lean a lot into the team because of something Alex mentioned earlier, that recursive reference in terms of the token pricing is really severe, and it's very unforgiving in terms of when it comes down. It's not just the overall revenue comes down, it really squeezes the operating margins of crypto teams. And so we looked at their resilience, we looked at their crypto nativity. And in terms of a thesis, we're these days about 80-20, so 80% in infra and 20% in applications. And in 20% in applications, we're looking for new primitives, new ways to bring on users, asset classes, more broadly speaking. And this is where we're kind of keeping a very open-minded mindset for teams to kind of share with us how they're seeing the next primitive to be built out. And we're excited, especially excited to see more teams coming out of Taipei, knowing that Perpetual Protocol, Super Oracles are two of my portfolio companies that have come out of this region that I'm still very excited about. On the infra layer, there are three things that we're still excited about over the next 12 months, despite what CJ referred to earlier as kind of this abundance of block spaces, abundance of layer 1, layer 2s. We're paying a lot of attention to FHE, ZK, and FHE, ZK, let's maybe first address those two. So in terms of FHE, we're seeing currently some hope around new types of ASICs coming out in order to get that hardware acceleration to boost the current state of the art from 4 to 5 transactions per second to something that's more usable. In ZK, we're still seeing new technologies and new proving systems, especially around folding schemes. We're yet to see a team to fully implement folding schemes that should drastically boost ZK proof generation cost and time. So, and we're also seeing in ZK collaborative starts and interactive shielding, being able to kind of be that turnkey solution for fully autonomous worlds to finally find the different interactive elements despite being shielded using ZK. So those are some of the areas that we're extremely excited about still at the infra and middleware layer.
First cycle, 2017-2018, the most profitable investments exchanges, centralized exchanges, and public chains. Central exchanges print the most money, and then the public chains print the most tokens. Well, I think this thesis still works till today for centralized exchanges to be able to make money. However, that whole market cap for unregulated central exchanges is going to be just keep decreasing. Actually, I said this end of 2021, and it's happening right now. So whoever's going to capture that market share is going to be decentralized exchanges with good liquidity to facilitate institutions to trade, and then is regulated exchanges that's going to be local ones around the different countries. And then the last cycle, we saw DeFi, GameFi, and we saw meme coin. So that's like the power of community, and that's like really fascinating. I remember back in the days that we were the first big exchange to list Shiba coin, and the Chinese government wasn't happy. However, for a day of trading fee, spot only on Huobi, Shiba was able to make a 6 million trading fee on spot only for one day. And the constant inflow and new users brought into the exchange only was over 10 million users. So that's like that's crazy. And for perps holding, so more than 1 million users a day for Shiba. So that's like the whole new concept was meme coin, and we're still seeing it, still being a trend. We're seeing tons of different kinds of meme coins right now, and I think that's like the power of the community right there. And then going to the future, like I said, and thanks Alex for sharing our joint portfolio company zk-Link. We love them as well, so they're definitely solving that issue. And two of our other portfolio company, one is actually a local one, Orderly. They're also trying to solve cross-chain liquidity aggregation. And then with Layer Zero as the third of our portfolio companies, it's kind of same track, the cross-chain messaging. I think that's going to be a very big sector. And another sector that we're thinking is going to be big in the future is data availability. We definitely see the very successful launch of Celestia. I don't really get why its market cap is this high, because I don't think they're worth it for now. Just like they still need a bridge to Ethereum, and it's not very cost effective. So we believe firmly there's going to be a better working data availability solution out there that's going to happen, and within an Ethereum ecosystem that doesn't really need a bridge, and also that can actually support instant data audit to promise the data integrity, and to be way more cost effective than what it is now, than Celestia and Eigenlayer. Hopefully these two can, further down the line can develop more. So that's like one of our other theses. And then third one, like I said yesterday on the panel with Alex, is an NFT marketplace based out of Asia. Exchange business is very in detail user operations, and that's just runs in the genes within the Asia community. All of the centralized exchanges are Chinese background, and it's very, very similar to running a spot exchange. So we definitely think the NFT marketplace is going to happen in Asia. So one of our other portfolio companies called Ubox, it was the original iBox team, and just to give you guys a little bit of data, they were able to make 100 million in profit last year, 2022, and that wasn't even a good year for an NFT marketplace. So the buying power is very, very strong in Asia. We need a place to serve all the buying powers out there with the great assets and with the protection of the user for the right selection process and due diligence process for the NFT assets. So I think that's going to be a huge one in the future as well.
Fantastic. So we're in the lightning round now. We've got about a minute left to ask a final question. I insist that the next answer you all give is a one-word answer. And we're going to end off with this, right? Is there any existing player, protocol, dApp in the space that you think has proven successful in what it's set up to do, has managed to evolve over the last few years, even if it's the last couple of months? And who would you say is that shining light looking forward? Alex?
Ethereum.
Roy?
Uniswap.
And Sierra?
Alex got my answer.
I thought we were going to get 3 different ones. All right, we've come to the end of the panel. Thank you all for being a lovely audience today, and thank you for being great panelists. Thank you, Bujadao and Taipei Blockchain Week. Thank you very much.